The financial crisis is not a problem of banks or money or credit default swaps. It is a problem of control. A very large and complex system is out of control. This type of problem pertains to a science called cybernetics because it is a problem of governance. Unfortunately, politicians and bankers don't seem interested in understanding highly complex systems. Last October, in a hearing before the Banking Committee in the United States Congress, Mr. Alan Greenspan, who helped generate the crisis as chairman of the Federal Reserve System, had this to say.
And what I'm saying to you is, yes, I found a flaw. I don't know how significant or permanent it is. And we have this extraordinarily complex global economy, which, as everybody now realizes, is very difficult to forecast in any considerable detail.
Now let's listen to Mr. Nassim Taleb, perhaps one of the most outspoken critics of the current crisis. He also points to complexity as part of the problem.
I said the center of the problem is that they don't know where the core of the problem is. Okay, the core of the problem is that the structure of the world in which we live is not adapted to the type of randomness we're facing. Okay, so
complexity is the key to solving the financial crisis. This is where cybernetics enters the picture. Cybernetics was born as the science of controlling communications 61 years ago. It's the science behind most of the technology that we use today, from computers, software, and communication satellites to the internet. As it propelled the information age, it also gave rise to the extremely complex world we live today. One of its branches, called management cybernetics, became expert in dealing with complexity. One basic lesson we have learned from management cybernetics is that highly complex systems control themselves. If their structure follows cybernetic rules, they work fine. But if the design is wrong, their performance cannot be controlled from outside. You have to redesign the system. All the failed government interventions, such as TARP, TALF, PIP, and the budget deficit, seem to confirm this lesson. All we can do about highly complex systems is build models and see if they mimic the relevant behavior. To build a model, we connect a list of variables, which are quantities that change over time. Information feedback traveling through the connections controls the behavior of the system automatically. For this reason, it is very worrisome to hear bankers, analysts, economists, and TV commentators talk about positive feedback to mean a good response and negative feedback to mean a bad response. This is a crucial mistake and could explain why things went so wrong. Positive feedback means that if a variable A increases or decreases, B does the same. When two positive feedbacks form a closed loop, the system runs wild. For instance, the size of a population and the number of mice babies born. The larger the population, the higher the number of mice born. As B grows, A gets bigger in return, and so on. Negative feedback has a reversal effect on the other variable. If A goes up, B goes down. Negative feedback connections work to correct runaway systems. In this graph, as A grows, B grows too. However, as B grows, it makes A smaller, which in turn makes B smaller. This loop is a self-balancing automatic control loop. The human body has many of these self-balancing loops. This is how body temperature stays constant. Something as obvious as allowing a positive feedback to run wild is what caused the financial crisis. Families, mortgage lenders, commercial banks, and investment banks became chained together in a gigantic positive feedback loop made possible by very low interest rates and plenty of hunger for commissions. Even the dollars spent to buy Chinese goods came back to help pump the housing bubble bigger and bigger. Cheap money from the Federal Reserve inflated asset prices. Banks created complex securities to generate more money. Then comes the reverse cycle. The housing market approaches saturation very fast. Subprime loans fail and dump houses into the market. Houses' price fall. Risk rises and lending stops. Delayed effects prevented a timely correction. What lessons were ignored? A mice population hits a natural barrier and runs out of food. Unlimited credit is impossible. The Titanic was going too fast and was slow to change its course. Yet another instance of the sorcerer's apprentice. Mr. Greenspan's reply was that the free market ideology had worked for 40 years. But wait, there's more. If this is a system and it is very complex, we say that it has a lot of variety. We also know a good regulator has to match the variety of the system it regulates. Achieving control can be done in two ways. We can amplify the variety going towards the system, or we can filter the incoming variety. This is the cybernetic variety equation. For instance, the government of the Soviet Union used repression as amplifiers to control people and used prohibitions as variety filters. In the United States, Homeland Security uses computers and cameras as amplifiers of controlled variety, and the issuing of visas as filters. The banking crisis has ignored the variety equation from the start, and now the government continues to do so. But it is the people who suffer from a very bad design. You see, banks amplify the variety directed at their customers, such as the creation of the credit default swaps. The government, in the name of free market, filters out whatever claims the people have against the banks. People get hit from both sides of the equation. This is how things should work. The customers use computers to match the bank's variety that has been filtered with the help of the government. The solution to the crisis is how you set up the variety equation. Can the government solve the problem by presenting highly complex solutions? Certainly not. The variety equation shows that complexity favors insiders who are close to the decision makers and gives them an unfair advantage. Now consider another related problem. We think of banking as one pyramid and government as another one, but watch closely and notice that they are connected by the tax funding of the Federal Reserve System. This means that both government and banking sit between taxpayers and bank customers. So, it's the people's taxes and credit that makes the whole system work. Now the question arises, how much are the people charged for these two services? You probably won't like the answer. The government and banking sectors have been growing like crazy the past several years and are now taking about 50% of GDP between them. Food producers and goods producers account only for 25% of GDP. Briefly said, guys that sweat take 25% of the economic pie. Guys that don't sweat take 75%. Finally, one last shocking conclusion. Banks and government have hijacked the computer revolution in their benefit. These two former pencil-pusher bureaucracies have offset the increase in personal productivity by placing the computer on the wrong side of the complexity equation. They create their own demand and cash in on it. This is a structural problem now. Check your 401ks. The system should be redesigned. Let negative error correction feedback do its work. Now you know why the crisis started, what keeps it going, and a good cybernetic hint on how to terminate it.